You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. I'm Susie.
And I'm Miro.
Today is February 7th, 2026, and we are looking at SAP's fourth quarter. And honestly, Miro, this felt like a magician trying to distract the audience while the rabbit died in the hat.
Yeah, it was messy. Efficient, but messy. If you look at the headline, they printed total revenue of 9.68 billion euros, up 7%. Cloud revenue hit 5.61 billion. Those are fine numbers. They basically hit the targets.
Right. Fine isn't exactly the word Wall Street was looking for, though.
Exactly. The problem wasn't the now, it was the future. The backlog, specifically the current cloud backlog, came in at 21.05 billion. That's up 25% year over year. To you and me, 25% growth sounds great, but the street was expecting more, and the CFO literally called it a pronounced slowdown. So naturally, they announced a 10 billion euro buyback program just to stop people from panicking.
10 billion. Just casual pocket change to say, please don't sell our stock. It's like bringing a diamond necklace to an apology dinner.
Basically. And it worked sort of. Look at the chart. Pre-market, the stock tanked, dropped from around 209 down to near 194 before the open. It looked ugly. But once the algos digested that buyback news, and maybe the fact that the sky wasn't falling, it crawled all the way back up to close flat, right around 200 euros.
Yeah, talk about emotional whiplash. Before we dig into why the backlog slowed down, because there is a very weird specific reason for that involving government contracts. Quick disclaimer for everyone listening. Nothing we say here is financial advice. We're just two friends reading the tea leaves, so please do your own research. Okay, so Miro. The CEO, Christian Klein, says they're in the penalty box with investors. That is such a vivid phrase. Why do they feel so persecuted when they're printing billions in profit?
Because the market thinks their growth engine is stalling. Operating profit was 2.55 billion, up barely 3%. Free cash flow actually dropped to 1.03 billion. When you combine a cash flow drop with a backlog slowdown, the narrative shifts from growth star to legacy utility. And nobody pays a growth multiple for a utility.
Right. So the buyback is them trying to force the multiple back up.
It's financial engineering. Why buy another company when our own stock is cheap? That's the logic. But it doesn't solve the core issue, which is that customers are taking longer to sign deals, or, as management claims, the deals are there, but they just can't count them yet.
Oh, I love that. The revenue is real. It's just invisible. That sounds like the perfect segue into the details, because apparently governments have some very annoying clauses in their contracts.
Termination for convenience. The three scariest words in a CFO's life right now.
Let's get into that. Why is half the public sector missing from the books?
Well, exactly. Termination for convenience sounds like a bad breakup line. But in government contracting, it's standard procedure, especially in defense. It means the client, say the German Ministry of Defense, can cancel the contract at any moment for any reason without penalty.
Okay, but if they signed the contract, surely they intend to pay?
Intent doesn't matter to accountants. If the client can walk away tomorrow, the accounting rules say you cannot book that revenue into the current cloud backlog. It's not guaranteed. So SAP has these massive public sector deals, hundreds of millions of euros potentially, that are technically signed, but legally invisible in the backlog metric.
So the backlog miss, that slowdown everyone freaked out about, is just an optical illusion? The money is there, but the accountants are hiding it?
That is the narrative management is selling. And to be fair, there is truth to it. The CFO, Dominic Awesome, was quite explicit about it. But it feels a bit like the dog ate my homework, doesn't it? You only blame technicalities when the headline number disappoints.
My backlog goes to another school. You wouldn't know her.
Precisely. But there is a deeper layer here, Susie. This isn't just about accounting. It's about who they're selling to. They're betting the farm on what they call the sovereign cloud.
Sovereign cloud? That sounds very imperial.
It's geopolitical, and frankly, it's their best defense against Amazon and Microsoft. The CFO actually took a swing at the competition on the call. He asked, and I'm quoting here, "Can I really afford to have an off-the-shelf, standard, plain, vanilla U.S. hyperscaler?"
Vanilla! He called AWS vanilla. That is fighting words in the tech world.
It's a deliberate strategy. They're telling European governments and sensitive industries, do you really want your data sitting on American infrastructure when trade wars are heating up? They're monetizing fear. Geopolitical tension is their moat.
That's fascinating. So they're basically the bunker for when the world gets scary. But Miro, if their strategy is buy us because you're scared of the Americans, that doesn't necessarily mean customers actually like the product, does it?
And that is the red flag I found buried in the presentation. You know the Net Promoter Score, NPS? The gold standard for customer happiness?
Yeah.
It dropped to 9 single digits.
9 out of 100?
Technically, the range is minus 100 to plus 100, but yes, a score of 9 for a cloud company is, let's just say it's not best in class. It dropped 3 points year over year.
Ouch. So people are locking themselves into SAP because of data sovereignty, but they aren't exactly thrilling the user base.
Right. And do you know how SAP is fixing it?
Let me guess. Better software?
No. They are deleting the metric.
You're kidding.
Dead serious. Starting in 2026, they are retiring NPS and replacing it with something called Cloud CSAT. When the scoreboard shows you losing, you invent a new game.
That's certainly convenient.
It's classic corporate hygiene. But look, combine it all. Invisible government backlog that we have to trust exists. A pivot to sovereignty because technology alone isn't winning. And a declining customer sentiment score that's being swept under the rug.
That paints a picture of a company that is fighting really hard to control the narrative.
And spending 10 billion euros on their own stock to make sure the market buys that narrative.
Right. So we've got a sovereign fortress, invisible contract, and some very grumpy customers, which is a complicated mix heading into a new fiscal year.
Very complicated.
So where does this leave them? If you step back from the specific accounting tricks, are they actually turning the ship or just painting it?
I wouldn't call it just painting, maybe gilding. When you announce a 10 billion euro buyback, you are reinforcing the hull with solid gold bars. That tells me they are terrified of the stock drifting, but it also says they have the cash to defend the floor. It's defensive, not aggressive.
Right. It feels like they're saying, we might not grow as fast as you want, so here's some cash to wait while we figure it out. But what are they figuring out? Is the play just sovereign cloud, or is there actually a next act for the technology itself?
Well, this is where Klein is trying to pivot the AI story. He's explicitly moving away from the chatbot hype. He was talking about agents, AI that writes poetry, but AI that manages inventory or chases cash flow.
That is the most German engineering take on AI imaginable. Forget the sonnet, optimize the supply chain.
I mean, honestly, I prefer it. It's boring, but it's monetizable. They aren't selling magic, they're selling efficiency. The risk is that the market wants magic right now.
True. So looking at 2026, they're guiding for cloud revenue to jump 20+%. That is ambitious, considering the backlog hiccups we just talked about. What's the watch item for you next quarter?
2 things. First, can they actually convert that invisible government backlog into recognized revenue next quarter? If that money doesn't show up in the print next quarter, the sovereign narrative breaks. And second, the lawyers.
The Teradata suit.
Exactly. They booked 174 million euro provision. That's a nasty hit to operating profit. If that litigation drags on or gets bigger, it's a landmine in the P&L. It's a distraction they don't need while they're trying to execute this transition.
So we've got a massive buyback to keep investors happy, a bet on boring AI agents, and a legal landmine taking in the footnotes.
Sounds like enterprise software to me.
Fair enough. It's never simple, is it?
If it were simple, Susie, we'd be out of a job.
You've got a point. All right, let's wrap this up before we find another footnote to worry about. And that is the quarter. Before we sign off, I want to take a brief moment to pull back the curtain on what you've just heard. Earnings Unscripted is an experiment by a small team of enthusiasts who are exploring the frontier of AI, and specifically how it can be used to enrich how we learn and listen.
It is a little meta, isn't it?
It is. To be transparent, this episode was created entirely by a team of AI agents. From the research analyst digging through the 8Ks, to the scriptwriter crafting our dialogue, to the voices of Miro and myself, and finally a fact-checking QA specialist making sure we stay on track. We're all working together to try and deliver high-quality, up-to-date information in a format that would hardly be possible otherwise.
And hopefully, we made it a little more entertaining than reading the PDF yourself.
That is the goal. If you have questions, comments, or just want to tell us how we did, please reach out. You can email the team at earningsunscripted@datamadness.ca or follow us on X.
Thanks for listening. See you after the next call.